Even after the gold standard has been abandoned since 1971, the value of gold is usually compared against currencies like dollars or euros. And even though the fiat currency has been in use since the 1970s, the purchasing power of these currencies has declined against gold. Yes, the gold is that powerful, and you're about to find out in this video the history of gold, the power it holds, the relationship of fiat money and its purchasing power, and way more. First off, who discovered this precious metal? The history of gold is older than the invention of writing or even pottery. So who are we to credit for its discovery? Right, absolute nobody. However, various cultures and religions began forming myths about the precious metal's origins as early as the 5th century before Christ. Since we are talking about gold here, the debate can never stop. For so many years, there have been lengthy debates about the archaeological origin of gold. No one is certain about the ancient civilization responsible for its lofty state in modern culture, but most historians agree that late hominids first found gold in shallow streams. Long before smelting and metallurgy, people took possession of gold in its natural state, as unwieldy yellow nuggets. There's just something about gold, even in its raw form, that gets you attracted. Talk about its brilliance and shine. Gold is just one very beautiful metal, but at the time, it could not be used as jewelry, weaponry, or currency. But one thing pure gold has is its resistance to aging and tarnishing. No wonder you can find most of the gold from the hominid era shiny and intact today, all surviving in your smartphones, computer chips, and watches. Far before the time of governments and economies, gold has been present in different corners of the world, some waiting to be discovered. Different tribes that have discovered gold began to use and trade it. For the Inca, the original inhabitants of South America, gold was seen as tears from the sun. When the Spanish conquistadors came to their shores in the 15th century, they began to hold a large amount between the Amazon River and the Andes mountain range, knowing gold what was the colonizers came to find. It's amazing how no one told even the earliest humans that gold is an object of value. Good has been seen as valuable and very useful. Tens of thousands of years ago, people started to form tools and weapons out of copper and iron, but gold is the oldest metal that did not need a fire, hammer, and mold to be fashioned into anything. Iron, copper, and most other metals occur as ore bodies, which require time and energy to smelt. But gold is different. It occurs in a natural, malleable form, making it the most easily workable metal in existence. It doubled in utility after humans discovered they could combine 2 or 3 metals to form one tool. Many gods in Egyptian, Roman, and Greek mythology have had spears, swords, and armor made from gold, and many ancient monarchs began to follow suit. In ancient times, the measly amount of gold that governments and trading companies could mine became idols, shrines, and holy objects. As time went on, gold became more and more precious and ubiquitous, and kingdoms started to fight one another, engaging in multi-year wars that would leave towns and cities decimated. After every war, the captured slaves, criminals, and prisoners of war were sent into gold mines to dig for gold. These ancient wars were not always over currency, as most of the time they were about land control, but gold was the primary enabler of these kingdoms to push harder and harder against one another. Soon, engineers got a hold of metallurgical techniques and began to perfect them. The more they got craft, the more permanent gold became in global currency. Goldsmiths from ancient Egypt formed the shekel, which was an alloy of 1/3 silver and 2/3 of gold. It became the primary unit of monetary measurement in the Middle East. The Romans had the aurum, the word that became the origin of the chemical symbol for gold, AU, which later became the basis for the pound, shilling, and pence that the United Kingdom uses today. Now let's talk about the gold standard. What is exactly the gold standard? Going by the definition of an extensive essay on the gold standard on the Encyclopedia of Economics and Liberty, it is a commitment by participating countries to fix the prices of their domestic currencies in terms of a specified amount of gold. This way, national money and other forms of money, like bank deposits and notes, were freely converted into gold at a fixed price. To make it simpler, a country under the gold standard would set a gold price, say $100 per ounce, and would buy and sell gold at that price. This effectively sets a value for the currency, In our fictional example, $1 would be worth 1% of an ounce of gold. Gold wasn't the only metal used to set a monetary standard. Even silver standards were more common in the beginning of the 19th century. We also have a combination of the gold and silver standard, which is known as bimetallism. So as gold became more ingrained in global currencies, many countries began to back their monies by the amount of gold their country could produce. Back in the 17th century, many English citizens had homemade mints where they marked their gold coins with the percentage of pure gold found in them. However, this practice began to produce coins of irregular shapes, sometimes robbing them of any value as a legal tender. Then there comes the Great Recoinage of 1696, which was an attempt by the English government under King William III to replace the homemade silver that made up most of the coinage in circulation, much of it being clipped and badly worn. With this recoinage, the English government tried to preserve the British currency's value in the country and abroad, but it was not a success. However, it gave rise to the early arguments for paper money, a more organized way of trading that will not see the light of day until the last days of World War I. The adoption of paper money started with the Americans before the British, but its value was reliant on the gold-producing capacity of the USA. But after World War I, the European governments were in shambles and international alliances began to shift, leading to an economic limbo felt across the world. Many nations were in debt, and gold production began to decrease as larger countries began to profit from the war. The US dollar and the British pound sterling became the world's reserve currencies, and people began to hold them more than gold. But what does the gold standard look like today? The gold standard is at rest as no country uses gold and silver as currencies. The precious metal is still ingrained in many facets of our lives as more and more uses are found for industrial and commercial applications. Nearly 80% of mined gold is turned into household decorations, watches, and jewelry, but the remaining 20% has an almost unlimited number of other uses. It's almost like gold is everywhere, from smartphones to GPS to calculators and even television sets. Also, doctors and dentists use gold for dental fillings, radioactive treatments for cancers, and diagnostic procedures. Can we even do without gold? As mentioned earlier, during most of the 19th century, the United States had a bimetallic system of money. However, it was essentially on gold standard as very little silver was traded. A true gold standard came to fruition in the 1900s with the passage of the Gold Standard Act. The gold standard effectively came to an end in the 1933 when President Franklin D. Roosevelt outlawed private gold ownership. However, the Bretton Woods system enacted in 1946 created a system of fixed exchange rates that allowed governments to sell their gold to the United States at a price of $35 an ounce. On August 15, 1971, the Bretton Woods system ended when President Richard Nixon ended trading gold at the fixed price of $35 an ounce. At that point, for the first time in the history, former links between the major world currencies and real commodities were severed. And since then, the gold standard has not been in use in any major economy. So how did the gold standard benefit the economy? Thanks to the gold standard, a relatively low level of inflation can be ensured. Looking at what causes inflation, we have a combination of 4 factors, which are 1, the supply of money goes up, 2, the supply of goods goes down, 3, the demand for money goes down, and finally, the demand for goods goes up. So as long as the supply of gold does not change too quickly, then the supply of money will stay relatively stable. The gold standard prevents countries from printing too much money. If the supply of money rises too fast, then people will exchange money, which has become less scarce for gold, which is not scarce. The more people exchange for gold, the faster the treasury runs out of gold. A gold standard restricts the Federal Reserve from enacting policies that significantly alter the growth of money supply, which in turn limits the inflation rate of a country. The gold standard also changes the face of the foreign exchange market. For example, if Canada is on the gold standard and has set the price of gold at $100 an ounce, and Mexico is also on the gold standard and set the price of gold at 5,000 pesos an ounce, then 1 Canadian dollar must be worth 50 pesos. The extensive use of gold standards implies a system of fixed exchange rates. Therefore, if we have every country on a gold standard, then there is just one real currency, which is gold. From gold, every other currency gets its value. The stability of the gold standard in the foreign exchange market is of benefit to the system and at the same time also a major drawback. Exchange rates are not allowed to respond to changing circumstances in countries. A gold standard severely limits the stabilization policies the Federal Reserve can use. Because of these factors, countries with gold standards tend to have severe economic shocks. Therefore, the vulnerability of economies under the gold standards led to unstable prices in the short run. So it would appear that the major benefit to the gold standard is that it can prevent long-term inflation in a country. However, the gold standard is not in use currently, and it doesn't seem like it will make a return to the United States anytime in the foreseeable future. So what system of money is in use today? Almost every country, including the United States, is on a system of fiat money, which the glossary defines as money that is intrinsically useless, used only as a medium of exchange. Should we mind the glossary's definition? Well, what is fiat money? We can say that fiat money is a government-issued currency that is not backed by a physical commodity such as gold or silver, but rather by the government that issued it. Its value is derived from the relationship between supply and demand and the stability of the issuing governments, rather than the worth of a commodity backing it. Examples are the US dollar, the euro, and other major global currencies that you know. Fiat, however, is unconvertible and cannot be redeemed simply because there is no underlying commodity backing it. And because fiat money is not linked to physical reserves such as a national stockpile of gold or silver, it risks losing value due to inflation or even becoming worthless in the event of hyperinflation. In some of the worst cases of hyperinflation, such as in Hungary, immediately after World War II, the rate of inflation can double in a single day. This points to the fact that if people lose faith in nation's currency, the money will no longer hold value. This is just the difference between a fiat currency and a currency backed by gold. The latter has intrinsic value because of the demand for gold in jewelry and decoration, as well as in the manufacturing of electronic devices, computers, and aerospace vehicles, something that the fiat currency will never have. If you're still wondering why the government thought about fiat money in the first place, the simple answer is that the gold standard was abandoned due to its propensity for volatility and its imposed constraints on the government. But does all of this mean that fiat money doesn't have at least an advantage? It does have advantages and disadvantages. But let's start with advantages of fiat money. Fiat currencies gained prominence in the 20th century, in part because governments and central banks thought to insulate their economies from the worst effects of the natural booms and bursts of the business cycle. Since fiat money is not a scarce or a fixed resource like gold, central banks have much greater control over its supply, which gives them the power to manage economic variables such as credit supply, liquidity, interest rates, and money velocity. For instance, the US Federal Reserve has the dual mandate to keep unemployment and inflation low, and using fiat money can help it meet those goals. This is what the government cannot achieve with the gold standard. Fiat money isn't bad at all if it can handle the roles that a nation's economy requires of its monetary units, which includes storing value, providing a numerical account, and facilitating exchange. It also has an excellent seigniorage, meaning it is more cost efficient to produce than a currency that is directly tied to a commodity. Now, the disadvantage of fiat money. The mortgage crisis of 2007 and subsequent financial meltdown tempered the belief that the central banks could necessarily prevent depressions or serious recessions by regulating the money supply. A currency tied to gold, for example, is generally more stable than fiat money because of the limited supply of gold. Also, there are more opportunities for the creation of bubbles with fiat money due to its unlimited supply. Obviously, the increase in the quantity of US dollar M3 currency and credit and the fall in the purchasing power measured against gold shows that the government's monetary statistic does not square with the market. Part of the reason is that government statistics do not capture all the credit in an economy, which means only bank credit issued by licensed banks is recorded. Also, dollars created outside the system, such as euro dollars, are additional and market prices fluctuate. Monetarists make little or no allowance for these factors, claiming that the purchasing power of a currency is inversely proportional to its quantity. While there is much truth in this statement, it is only suited for a proper gold-backed currency, when one community's relative valuations between currency and goods are brought into line with those of its neighbors through arbitrage, neutralizing any subjectivity of valuation. The classical representation of the monetary theory of prices does not apply in conditions whereby faith in an unbacked currency is paramount in deciding its utility. A population that loses faith in its government's currency can reject it entirely despite changes in its circulating quantity. This is what wipes out all fiat currencies eventually, ensuring that if a currency is to survive, it must eventually return to a credible gold exchange standard. We see the weakness of fiat currency in Europe in the 1920s when the Austrian crown and German paper mark were destroyed. Following World War II, the Japanese military yen suffered the same fate in Hong Kong, and Germany's mark for a second time in the mid-1940s. More recently, the Zimbabwe Zimbabwean dollar and Venezuelan bolivar have sunk to their value as waste paper, and they are not even the only ones. Ultimately, it is the public that always determines the use value of a circulating medium. This chart of the oil price measured in gold grams, dollars, pounds, and euros shows that between 1950 and 1974, a gold standard, even in the incomplete form that existed under the Bretton Woods Agreement, coincided with price stability. It took just a few years from the ending of Bretton Woods for the consequences of the loss of a gold anchor to materialize. Until then, oil suppliers, principally Saudi Arabia and other OPEC members, had faith in the dollar and other currencies. It was only when they realized the implications of being paid in pure fiat that they insisted on compensation for currency debasement. That they were free to raise oil prices was the condition upon which the Saudis and the rest of OPEC accepted payment solely in US dollars. In the years that followed the war between 1950 and 1970, US broad money grew by 167%, yet the dollar price of oil was unchanged for all that time. Similar price stability was shown in other commodities, clearly demonstrating that the quantity of currency and credit in circulation was not the sole determinant of the dollar's purchasing power. The truth is, currency valuation fluctuates constantly, driven by the flow of funds between markets. The two biggest drivers are central bank policies and economic growth relative to inflation. In the market, when there is an economic unrest, investors dump their greenback in favor of gold. As mentioned earlier, gold is not like other assets. It maintains its natural shine, what you may prefer to call its intrinsic value. Gold hitting an all-time high didn't just start today. At the end of 2023, gold prices sold to an all-time high of $21.35 an ounce. With interest rate cuts and cooling inflation on the horizon last year, what is the gold price forecast for 2024 and beyond? Gold prices surged in the last few months of 2023 after a powerful rally was sparked by central bank and mounting investor concern over the Israel-Hamas and Russia-Ukraine conflicts. After a hiking cycle that pushed the Fed funds rate to its highest in more than 22 years, policymakers on the Federal Open Market Committee have indicated at least 3 rate cuts in 2024, as inflation eases from the 40-year highs seen in mid-2022. With gold prices hovering around $2,000 an ounce, we can ask ourselves if another bullish run is expected for the precious metal as rates begin to fall. This year, commodities are not expected to benefit from core inflation. According to Natasha Kaneva, head of global commodity strategy at JP Morgan, inflation should fall to under 3% so that, along with properly timing the business cycle, are the two conditions needed to initiate long positions, making the outlook for a sector very tactical in 2024. Economic and geopolitical uncertainty tend to be positive drivers for gold, which is widely seen as a safe haven asset due to its ability to remain a reliable store of value. It has a low correlation with other asset classes, so can act as insurance during falling markets and times of geopolitical stress. A weaker US dollar and lower US interest rates also increase the appeal of non-yielding bullion. Anticipation has played a key role in sparking the rally in gold's price, as it is influenced by market expectations of future Fed policy. As stated by Gregory Scherer, head of base and precious metals strategy at JP Morgan, across all metals, only gold and silver have the highest conviction on a bullish medium term throughout 2024 and into the first half of 2025. However, any retracement could provide investors with an opportunity to begin positioning for a breakout rally that would commence around mid-2024 as US GDP growth slows and expectations of an imminent Fed cutting cycle rises. According to JP Morgan research estimates, gold prices will peak at $2,300 an ounce in 2025. This prediction assumes a Fed cutting cycle initially delivering 125 basis points of cuts over the second half of 2024, pushing gold prices to new nominal highs. Gold price predictions are based on Fed official forecasts, which see core inflation moderating to 2.4% in 2024 and 2.2% in 2025, before returning to the 2% target in 2026. By the second quarter of 2024, JP Morgan economists forecast US growth will slow to 0.5% quarter on quarter. This should prompt the Fed to start cutting rates in June, ultimately delivering 125 basis points of cuts in the latter half of the year to avoid a recession. It is believed that over this period, the Fed cutting cycle and falling US real yields will once again become the mono driver behind gold's breakout rally later in 2024. Gold's inverse relationship to real yields has historically been weaker over Fed hiking cycles, before strengthening again as yields fall over a transition into a cutting cycle. Ultimately, this should drive gold prices to new nominal highs in the second half of 2024, averaging $21.75 an ounce in the fourth quarter and even higher in 2025, looking at quarterly average peaks of $2,300 an ounce in the third quarter. Crazy enough, there have even been predictions of about $4,000, $8,000, and $12,000 per ounce of gold. Unbelievable, right? Here's why the prediction sounds too bullish. According to an Invesco survey, more countries are bringing back their gold reserves to protect them against the sort of sanctions imposed by the West against Russia. In other words, just so they won't lose money, these countries are moving their foreign reserves home. Interestingly, some emerging countries are also seeking to move away from the US dollar. It means they are losing faith in the Fed and the US government. We may see further escalations of geopolitical tensions, and it is possible that the situation with Russia's foreign reserves was a precedent in a way. As we have seen from Invesco's report, many countries now find it unreliable to have their assets sold abroad. For a while now, the Fed, just like many other central bankers, has been raising the interest rates. At the same time, the gold prices have been holding up very well. This negates what we have always known. Normally, higher interest rates are very bearish for precious metals, but right now, gold is really bullish. Take a look at this chart. It shows the real interest rates in the US and their relationship with the gold prices. As you can see, the correlation between the US real interest rates and the gold prices is negative. As the interest rates increase, the gold prices should decrease. In the recent several months, however, we have seen quite the opposite situation. The interest rates are rising, whilst gold is still trading high. But even if there is a bullish prediction for gold, why $4,000 or $8,000 an ounce? Where exactly did these numbers come from? The Fed may get more dovish than it is now. But to see the reason for this dramatic bullish prediction, we should talk about the valuation ratio, the US money supply, and the historical gold prices. The best time to buy gold is when the Dow to gold ratio is at its lowest. And we can say this is happening now, the way it was just before the dot-com crisis, before the 1970s and the Great Depression. This chart shows gold's performance versus that of the general stock market. We can see that in past decade, gold has been doing very poorly compared to stocks. This might signal the precious metals undervaluation. An average Dow to gold ratio is about 10. Right now, it is lingering around the 20 mark. This means gold should be 2 times more expensive given the current Dow Jones valuation. But what's more striking is the gold to liquidity ratios. Usually, a high money supply makes gold bullish. However, presently, that's not happening. Although the gold to monetary ratio is very low, while gold should be 2 times higher than it is right now, it is not. Also, let's look at the Fed balance sheet versus gold price. The fact that the Fed's balance sheet is so high means it's owed a large amount of securities, whilst the money supply in the economy is high. Still, given this fact, the gold price is extremely low. However, record lows lead to new all-time highs. This happened in 1980 and also in 2011. In the first case, the gold prices surged tenfold, and in the second case, they rose by 100%. So it is realistic to say that if the Fed should start easing the monetary policies, the gold prices could surge to 4,000, maybe 8,000 mark or even more. Here's more explanation. According to the Dow to gold and gold to monetary base ratios, gold should trade nothing less than 2 times higher than it is now, provided everything remains the same. Gold is presently above $2,000 per ounce, so 2,000 multiplied by 2 will give us $4,000 an ounce. That is if we are putting aside the high geopolitical tensions causing many countries to invest in gold so much. So if something bad happens on that front again, many investors could start panic buying the precious metal. And if it reaches 4,000, why not $12,000 per ounce? Crazy, right? The fiat currencies have been losing power and value against gold for over 40 years now, and it doesn't look like it's going to come to an end. Gold is a powerful metal, and what makes it retain that power is because it's never going to lose its intrinsic value, unlike other assets. What do you think about this metal? Should the government have continued the usage of the gold standard? Also, do you think there's a future for the fiat currency? Subscribe and let us know in the comment section.